Hello, people. So I figured I'd share um, a mail message I received from a newsletter I subscribe. It deals with the current affair of the world economy and a divergence that has been noticed by this guy named Rick Pendergraft. So I'll be reading from the source and I'll be showing to you what I mean. You probably are seeing my virtual drive feed. So let's start. It's this gentleman, Rick Pendergraft, from Investors Daily Edge, one of the few newsletters about stocks and the economy and finances that I find is quite useful in decision making. So he says like this: we have seen the banks and brokerage houses miss on their earnings estimates, and in most cases, their profits are either way down or they slipped to losses. On the other hand, the non financial earnings reports have been better than expected for the most part. Most of the companies are showing modest growth in the first quarter. From Google to Apple, Boeing to McDonald's, these companies have exceeded earnings estimates. Some of these companies have charged higher, some have dropped, and some have had little reaction to the earnings reports. As it had been said many times before in Investors Daily Edge, it is all about expectations when it comes to earnings. This may seem all well and good, but I find it concerning. Historically, it has been the financials that lead the way out of recessions. This point is quite important. The Fed lowers interest rates in order to make credit more readily available, and the banks benefit from the increase in loan demand. But I don't see this happening right now. Just last week, mortgage applications showed a 14% decline from the previous week. Both existing home sales and new home sales are at multi level lows. While the Fed has been dropping rates, the mortgage rates have not been declining. Why is this, you ask? From where I sit, it looks like banks are keeping mortgage rates higher than usual. What I mean by this is that they are setting the rates with a higher spread between what they can borrow at and their lending rate. Back when this guy was a branch manager in a bank in Ohio, the rate on the 30-year mortgage usually ran about 1.5 to 2 points above the 10-year treasury note rate. Right now, this yield on the 10-year treasury is at 3.85%, while the national average for a 30-year mortgage is 7.15%. This is a spread of 3.3%. You can't really blame the lending institutions. After all, they are trying to recoup some of their losses from the ongoing subprime fiasco. The problem is that by keeping the rates inflated, the demand for loans remain low. So he has stated on several occasions that um, he doesn't look at for the economy to improve until the housing market improves, blah blah. And then, given that new home sales in March dropped to the lowest level in almost 17 years, and the existing home sales declined after a mild jump in February, I don't see foresee I don't foresee a big improvement in the housing market anytime soon. And so, non-financial companies have been reporting better earnings than expected, but the financials have been reporting worse than expected earnings. If this pattern continues past this quarter, the non-financial companies will start to see a decline in earnings as the consumer becomes more and more strapped financially. Food and energy prices continue to skyrocket, eating up more and more of the household income. In the meantime, credit is not as accessible as it has been for the last 10 years, and we all know that this is not a country of savers. So if food and energy continue to climb, credit remains tight, and the housing market doesn't improve, the economy is going to get worse before it gets better. The weakness in the earnings of the financials could be leading us deeper into recession rather than leading us out of one this time. So this was my message. I thought you should be aware of this situation, this divergence that this guy noticed. I